The immediate catalyst of the Q1 2026 economic crisis was the weaponization of the Strait of Hormuz. By closing this choke point, Iran instantly removed 20% of global daily oil consumption and 25% of the world's liquefied natural gas flows. Precision strikes against sovereign energy infrastructure have engineered a structural supply shock, permanently removing physical production capacity from the grid. This triggered a violent commodities superspike, pushing Brent crude past $110 a barrel to a peak near $126. Yet amid this extreme geopolitical volatility, traditional safe haven assets are failing to perform as expected. Gold is suffering significant declines, while capital flight overwhelmingly surges into the US dollar. This divergence breaks historical institutional risk models, requiring a complete repricing of global risk across all asset classes. We will map the contagion from these geographic choke points to corporate balance sheets, outlining the immediate defensive playbook for CFOs and investors. Surviving this macro regime requires abandoning passive historical assumptions and aggressively restructuring both supply chain legalities and portfolio mechanics. The conflict began with a strategic shift from simple naval blockades to permanent capacity destruction via targeted infrastructure strikes. Targeted strikes hit Qatar's Ras Laffan LNG facility, the UAE's Shah gas field, and key Saudi Arabian refineries. The regional contagion was immediate, with European wholesale natural gas prices more than doubling overnight. The disruption has cascaded into a secondary contagion, a sudden global agricultural crisis triggered by bulk shipments trapped in the Gulf. As shown here, trapped shipments have caused critical fertilizer prices to jump 26%. The technology supply chain is also under pressure, as the conflict has reduced global air freight capacity by an estimated 9%. Crucially, the crisis has constrained the Middle Eastern supply of helium and bromine. These raw materials are strictly required for global semiconductor fabrication and the manufacturing of AI infrastructure. Weaponizing Gulf geography has instantly degraded both foundational global agriculture and the deployment timelines for cutting-edge technology. The physical energy supply shock has translated upward into a violent revival of global inflation concerns, forcing central banks like the Federal Reserve to solidify a higher-for-longer interest rate environment. High real bond yields are overshadowing gold's appeal as a non-yielding safe haven. Consequently, investors are rapidly unwinding crowded, momentum-driven positions in precious metals. As a direct consequence, this massive wave of institutional capital flight is funneling rapidly and forcefully into the safety of the US dollar. The dollar is breaking decisively higher against traditional peer currencies like the Japanese yen. Other historical safe haven currencies, specifically the Swiss franc, are experiencing significant collateral damage. This restrictive macro outlook and the high cost of capital continue to suppress global equity valuations. Regional exchanges like the Dubai financial market have been dragged into bear market territory. The flight to the dollar confirms that in a high-yield inflationary crisis, yield generation wholly eclipses the illusion of physical safety. On a micro level, dollar dominance is creating an operational crisis for multinational corporate balance sheets. The pressure on emerging market currencies has caused a severe cross-border liquidity squeeze. Maritime logistics are facing extreme friction, with insurance premiums for the Persian Gulf rising by 50%. Major syndicates are outright canceling war risk coverage, leaving finance teams to quantify potential uninsured losses. The logistical alternative requires rerouting shipping fleets entirely around the Cape of Good Hope. This massive maritime detour adds critical weeks to delivery schedules, actively forcing logistics teams to reconfigure entire inland transport networks. This necessitates a ruthless audit of vendor and supplier contracts. Pay exact attention to how war is specifically defined within your force majeure provisions. That exact contractual definition dictates whether the supplier or the buyer absorbs the catastrophic material price escalations and fuel spikes. CFOs who fail to align their legal definitions with these new operational reroutes will absorb immediate margin destruction. Finance leaders must move to an active defensive posture to counter prolonged dollar strength. Forward-thinking treasuries are increasingly leveraging enterprise stablecoins and blockchain-based settlement networks. This digital infrastructure bypasses strained traditional correspondent banking to ensure instant 24/7 cross-border liquidity without legacy FX friction. Corporate supply chain managers importing technology must tap into backup inventories immediately and absorb higher air freight premiums to secure AI infrastructure timelines. Institutional investors should hedge against inflationary pass-through using U.S. Treasury inflation-protected securities and out-of-region energy equities. Aerospace and defense equities remain clear structural beneficiaries of the acceleration in global sovereign defense spending. Gold must be navigated with caution, as it remains highly susceptible to momentum-driven selling in this macro environment. Institutional capital is instead assessing decentralized digital assets and DeFi infrastructure as a censorship-resistant store of value that operates outside the geopolitical banking system. Extreme panic-driven commodities moves eventually exhaust themselves. Astute institutions must build digital resilience now to prepare strategic buy-the-dip campaigns for discounted global equities once the immediate panic fades.